Welcome back to the channel. Today we're diving into a topic that every investor, or even someone just getting started in the markets, needs to understand: how to grow your money and potentially generate income at the same time. Specifically, we're going to explore two different investment approaches using the same starting point: $100,000. We'll look at one strategy that leans toward growth, but still produces dividends over time, and another strategy that prioritizes steady income from day one. Both can turn $100,000 into a multi-million-dollar portfolio, but they do it in very different ways. By the end of this video, I'll show you exactly how one approach can grow that $100,000 to roughly $6 million, while the other builds a portfolio that can pay over $28,000 per month in dividend income. We'll also talk about how your own behavior, your tolerance for volatility, and even taxes can affect which path is better for you. So grab a pen, take notes, and let's break it all down. Before we start comparing anything to Schd, it's crucial to understand that not all index funds are built the same. You've probably heard of Fidelity. They offer a bunch of major index funds, but each one has a slightly different goal and a different approach. If your aim is to understand where growth and income naturally intersect, you can't just lump them all together. You have to look at the funds individually. I analyzed 5 well-known Fidelity index funds, not to rank them and definitely not to declare a winner, but to understand their purpose, behavior, and what kind of investor each fund fits best. This step is really important because skipping it often leads investors to make the wrong assumptions about risk, return, and long-term income potential. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with the classics. Fidelity 500 Index Fund, FITLX. This is the quintessential growth engine. It holds the biggest U.S. companies and is designed to track the market over time. Yes, it pays a dividend, but that's secondary. The real value comes from price growth. Fidelity Total Market Index Fund, FZ rocks. This one takes a broader approach. Instead of concentrating on large cap companies, it invests across the entire market. You get a little bit of everything, which is great for diversification, but again, income is a byproduct, not the focus. Fidelity Large Cap Index Fund, FITLX, looks different on paper, but in practice, it behaves similarly to FITLX. Strong growth, modest income, mostly driven by market movements. Fidelity Nasdaq Heat Composite Index Fund, FNCNX. Here, growth gets a turbo boost. This fund focuses on innovation and price appreciation. Income is almost negligible and volatility can be high when the markets dip. Fidelity U.S. Sustainability Index Fund, FITLX. And here's where things change. FITLX isn't chasing pure growth and it isn't trying to maximize income either. It sits right in the middle. This fund focuses on companies that generate real cash, manage themselves prudently, and consistently return money to shareholders. That combination creates a balance between growth and income, which is exactly why FITLX is worth comparing to Schd. Don't get distracted by labels like sustainability. FITLX is essentially a growth and income hybrid. It invests in large, profitable companies with room to grow. Almost 40% of the fund is in technology, 11.7% in communication services, and 11.2% in financials. These are growth-oriented sectors driving price appreciation. But FITLX isn't just tech-heavy, it also holds healthcare, consumer cyclical, and industrial companies, giving it balance and durability. Top holdings: Microsoft, Alphabet, Nvidia, Visa, MasterCard, Eli Lilly, Tesla. These are companies with strong margins, pricing power, and reliable free cash flow. They aren't dependent on cheap debt or perfect market conditions. They generate cash first and decide how to allocate it later. Here's the kicker. The dividend yield is modest, about 1.1%, but the dividend growth rate is roughly 15% annually. That means income isn't the focus at the start, but it compounds over time. Meanwhile, average annual share price growth is over 13%, so you're not sacrificing growth for income. This fund is built to thrive in multiple market conditions. When markets soar, tech and communication sectors pull growth forward. When markets stall, cash-rich balance sheets and rising dividends stabilize returns. FITLX is designed to let growth and income rise together. Now let's flip the coin and look at SCHD, the Schwab US Dividend Equity ETF. SCHD is simple. Its priority is reliable, predictable income. Everything else is secondary. About 55% of the fund sits in defensive, cash-generating sectors: energy, 18.9%, healthcare, 18.1%, and consumer defensive, 18.1%. Tech makes up only 10% of the fund. Top holdings: Merck, Cisco, Amgen, AbbVie, Coca-Cola, PepsiCo, Chevron, ConocoPhillips. These are mature companies with strong free cash flow. They're not chasing growth. They're built to return cash to shareholders. SCHD's dividend yield sits around 3.75%, over 3 times higher than FITLX. Dividend growth is strong and predictable at about 10.6%. Price appreciation is slower, averaging 7.8% annually. That trade-off is intentional. You give up some growth for consistent income. Here's a key point. Investing isn't just about charts, percentages, or market crashes. It's about behavior. Volatility creates doubt. With a growth-heavy fund like FITLX, most returns come from price appreciation early on. That can be stressful when the market dips. With SCHD, dividends continue even during market slumps. Cash flow provides reassurance and reduces the emotional pressure to make mistakes like selling at the wrong time. So, which fund works for you? FITLX asks you to tolerate more movement for long-term growth. SCHD reduces emotional friction by paying you along the way. Neither is better. It depends on how you react to market ups and downs. Taxes also play a big role in long-term results. Dividends are typically taxed when received. For SCHI, that 3.8% yield is taxable every year, reducing compounding in taxable accounts. FITLX has a 1% yield, so more of its returns are deferred and left to compound. In tax-advantaged accounts like IRAs or 401ks, this difference mostly disappears. But in taxable accounts over decades, FITLX can compound more efficiently. Let's look at projections for $100,000 invested over 30 years. FITLX, starting dividend yield 1.1%, dividend growth 15.42%, average annual price appreciation 13.38%, 1 year $114,477. 10 years $390, $444, 20 years $458,441, 30 years $407,191. Annual dividends at 30 years $109,140, $9,153 per month. SCHD, starting dividend yield 3.82%, dividend growth 10.61%, average annual price appreciation 7.82%, 1 year $111,640, 10 years $314,954, 20 years $120,352, 30 years $466,601. Annual dividends at 30 years $340,515, $20,376 per month. Here's the takeaway. FITLX produces roughly $1.7 million more in total portfolio value, while SCHD produces roughly $1,900 more per month in income. Total value versus total cash flow, the trade-off is crystal clear. It comes down to your goals. Want maximum wealth accumulation? FITLX wins. You tolerate more volatility and let growth drive long-term results. Want reliable cash flow now? SCHD wins. You sacrifice some total growth for predictable, steady dividends. It's not about right or wrong. It's about matching your investment strategy to your behavior, risk tolerance, and long-term goals. So, to wrap it up, FITLX sits naturally in the middle between growth and income, giving you a balanced approach where dividends compound quietly while growth drives your wealth. SCHD is a focused income fund, giving you cash flow from day one at the expense of slower price growth. Both paths can turn $100,000 into millions. FITLX can reach $6.4 million over 30 years, while SCHD can generate over $28,000 per month in dividends. The choice isn't about which is better, but about which aligns with how you think, behave, and want to experience investing. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.